Okay, great. So this is part 2, and again, 5 minutes. The key issue here was that I just talked about the double entry system, but let's just talk about the process. So in accounting, we must have a process. Anything else besides following the process is technically fraud, because you see, you can't have information instead of financial statements without there being a source. So we always start off with a source document. When I say a source document, it could be an invoice, credit note, if you like, receipt, something. And this has to go into the system. So what do we have? Source document has to go into the system. And what we have in accounting is 6 nice, neat diaries. They are diaries. They are books of prime entry. There's no double entry happening yet. We're just taking our invoices and arranging them all nice and neat. And so we have, first of all, as you can imagine, we must have had what's referred to as the cash book. The cash book does look like a T accounting, but fundamentally it's still a list. And we record any monies coming into us on the debit side, any money's leaving us on the credit side. And of course, when we traded in cash and we didn't deal in credit, we probably only had the cash book, and we could just look in the cash book at any time and find out what our profits were. But then, of course, we have a credit scenario where we're buying and selling goods on credit. So, of course, we now have what's referred to as a sales day book, a purchase day book, a sales returns day book, a purchases returns day book, of course, the cash book, and we also have what's referred to as the general journal. So, sales day book, or let's start with purchases day book. When we buy goods on credit, we get sent invoices. So, if you like, think of it as a list. It is fundamentally a list. We have A, B, C, D. We have a list of all the invoices that we owe people. We write them in this nice list, and then we write the total, and we get that up done. Same thing, when we now sell the goods, we generate our own invoices and we send those invoices out. So X, Y, Z, we sell, these are our customers, our credit customers, and whatever, 5,000, 2,000, 3,000, or whatever it is. Same thing, sales returns day book, or let's say purchases returns day book. We're not happy with some goods, we send the goods back. The supplier sends us a credit note, so credit notes get entered here. So credit note 1, credit note 2, credit note 3, £50, £30, £40. And sales returns day book, the customer sends us back the goods they're not happy with, and we send them credit notes, and we record those credit notes in here as well. Then, of course, we have what's referred to as the general journal. So, for example, these items, these books, these 4 books I'm ticking here, fundamentally deal with goods that we're selling, trading items. But imagine we buy a machine, or we invest money into the business, or we're correcting an error, and there's no physical source document per se, so we record everything in the unusual. We just call these unusual transactions. Not bad, just unusual. They don't happen often, and we record them in the general journal. And we use the language of debit and credit. So, for example, like what I just said, if I buy a machine for cash, or if I buy a machine on credit, I've acquired an asset. I said in my first video, whenever we buy an asset, and it goes up, we debit it. We're paying, we still owe, we have a liability or a loan company, something like that. And so this is these are your subsidiary books. And then, of course, what happens next is that the information moves in from here. Once we've written all of this, oops, let me just move that out. So we have our totals, for example. So I'm just going to pretend here and just deal with purchases. For example, imagine I bought 100, 200, 300, 400. So 3, 6, 1,000. This is my information now. My double entry begins. And this information moves from my day books to my ledgers. Think of ledgers as roofs. So the first ledger, the only ledger I'm going to talk about in this video is the general ledger. This is where my double entry begins. So I have my purchases of 1,000, and I have my purchase ledger control account of 1,000. This is a trade payable account. This is the liability account, L, and that's E. 1,000 here, 1,000 here. That's the double entry. Yeah, that's the double entry. So, what do we have? Well, I'm almost at 5 minutes. I want to be quick. So now we have my double entry, and from my double entry, then I'm going to do what we refer to as balancing the accounts to finish off this video. We don't actually have to do, I think the next video will allow me to talk about the trial balance, but fundamentally, I will have my T accounting begins in my ledgers. So I'm just going to focus on the one ledger now, first of all, the general ledger. So that's my general ledger. So, for example, you've bought some goods on credit, and then let's just say you decide to pay. If you decide to pay your supplier, you might, a check of 500, you write the check in there, and say you pay 2 suppliers, 500 and 200, so 700 you've paid out. Well, that total, of course, now as well comes in here. So what do? I have bank, 700 out of here, and 700 out of here. So you can see that now we're doing the double entry, bringing the information in from the subsidiary books into the T account. Remember, I'm preparing these accounts here in the general ledger so I can end up preparing my income statement or my profit or loss, or if you like, find out what I minus E is. So far, I've been dealing with, I can see an E kind of taking place. That's my E, isn't it? My purchases. But I'm also recording my A's and L's, and this is an L, and this is an A. So you can see this is the whole point of this. Then I returned some goods on credit. I wasn't happy with these goods, so I returned, say, £50 worth of goods, and he sent me a credit note. So what do? So we have a total of credit notes from all three to different suppliers, 50, 30, that's 80, 120, total 120. So what do? I now have purchases returns. Purchases returns. I returned £120, and I also have £120 here. Basically, this is reducing the amount I owe to the client, and that's 120 over here. I've gone over my 5 minutes. So what do? I can balance. We have to balance our accounts. So look at the video. How do I balance my accounts? Or look at the book. We look at both sides of the T account. We find out what side's the bigger one. That's step one. We know the bigger one now, so we have 1,000 here, and we also write 1,000 here. So now that we know the bigger one, we can now, I'm just going to erase this just to get this out of my, move this bank out of my way so I can treat this balancing. Or why not? Let me just do it on a better page. So that's my balancing. I'm just going to pick a few numbers. It doesn't really matter what I do. It could be any account that you're balancing. I'm just going to go with bank. Bank. So imagine you had £1,000, you had 2,000, you had 3,000. Here you had 50, you had 40, you had 80. And you had 120. How do I balance this? So the rule is add both sides up, find the bigger side, and then what do we have here? Yes, we have 2,000, so we have 6,000, 6,000. And what we're really saying is, by how much is this more than this? So, well, it is, well, this is 200, this is 290, so I need to take off 290 off this, and that sounds like 5,710. This is your balance. So balance carried down, we call it carried down. That's the balance. That's the difference between this big side and this weak side, and that's the total over there. And this balance carried down comes down here as a balance brought down of 5,710. Right? So that's how we balance accounts. I've gone over 3 minutes. I said probably 5 to 8, and that's the end of chapter 1. I'll do a video on chapter 2. So quickly, watch the normal class videos. These are short boosters, and then do the questions at the back of the book of chapter 1, and you start prepping yourself. Great stuff.